Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Phil, welcome to episode 5 of this insurance deep dive. How you going?
Good, mate. How are you?
Good, mate. Good. Today, we're talking about the application process of insurance. So far, for folks that haven't tuned in, we have covered like an introduction to personal insurance, lump sum insurance. So that's like life, disability, trauma, child's cover. Number 3 was all about income protection, which people will be familiar with, but that was a really important episode. Number 4 were the different ways to purchase insurance. So you talked about for personal insurance, it might be through super, going direct. It might be through an advisor such as Skye Wealth. In this one, we're going to talk about the application process and just kind of the whole process. This is where I'm in the process of getting insurance through you guys. So this is like really timely for us. But one of the things that's been made apparent to me, and we have kind of alluded to this throughout the series thus far, is I've held a lot of insurance through my superannuation fund. And it is well above the default levels that we've talked about in previous episodes. So I went in and I thought, I need more cover than what they're offering, like the 140 or whatever it was at the time. I need a lot more than that. I run a business, got a mortgage, probably have kids in a few years. Like I want to prepare for all of this. But then it was revealed to me, someone told me, and this is what kind of, I'm hoping you can bust this myth, is I didn't do the full medical underwriting for that. And I've got a lot of insurance. So if the time comes sometime in the future where I do make a claim, that will obviously be reviewed. And is it possible that an insurance company could deny my insurance or if like my estate, if they make the claim, even though I've been paying the premiums? Does that make sense?
Yeah. It's a good question. So there's a few things. So if you told a mistruth in the forms that you filled in, so you would have gone through a 20, 30 questionnaire online. And if you made, an inaccurate statement, or back when you did it, you probably had what's called a duty of disclosure. So the requirement was all on you as an applicant to make sure you've disclosed everything accurately. Then they can decline a claim if you haven't disclosed accurately. Now, one thing with the Life Insurance Act is if they don't ask a question, then it's easier for you to argue at claim time that, hey, you didn't ask me that question, and so therefore, it's reasonable that I didn't offer you that information. But under the old rules of duty of disclosure rules, the requirement was all on the applicant to make sure that they are giving all information. These days, it is much better in terms of the legal requirement to make sure you take reasonable care to not misrepresent. So the onus is now a bit more on the insurance company to make sure that they're asking the right questions. But it is still a little bit tricky depending on when you took out a cover based on that duty of disclosure. But generally speaking, if you didn't lie or misrepresent at the time that you made the application, then it would be pretty difficult for the insurance company to decline a claim under that requirement. And one thing that is a bit of a myth is insurance companies don't pay out claims. Over 90% of all claims that are submitted are paid out. So a huge percentage of claims are paid out in the life insurance space.
Okay. So this is probably a good chance to talk about how the actual process takes place. So some people will know or have heard of, and we talked about it, default cover inside their superannuation. If they sign up to like REST or Australian Super or insert name of superannuation fund, the default level of cover. We mentioned in the previous episode how people can effectively pay for insurance through their super or by going direct or by using an advisor. But I'm at the stage now in the Skye process where I have paid the upfront advice fee, and now my wife and I, we're going through the fact find, which is really detailed. It's all online, like I'm just filling it in. Just describe where I'm at now, the application process, how that might differ for different types of people purchasing insurance, and what unfolds from here.
Yeah, so the actual insurance application stage, we're not there yet. So for where you're at, we are preparing our advice. So we get you to do very similar medical questions for us, because then we take that to the insurance company and then get them to, it's basically called a pre-assessment. They will pre-assess a potential application, and they'll come back with saying, hey, we will exclude mental health, or we'll exclude your back. And another insurer will say, hey, we're happy with the mental health treatment and symptom in the past. We're not going to exclude that, but maybe we'll exclude the back. And a third company may say, hey, we're comfortable with all of it. It's within our risk profile of comfortable level as long as everything's true and correct. So we're not going to put any exclusions on. So we do that research up front in the advice process to make sure we're recommending the insurance provider who's going to provide, the most appropriate terms. And we'll talk about terms and exclusions and loadings a little bit in this conversation. So this is before we even talk to an insurance company with your individual application.
Okay, so you get all the information so that you can then anonymize it, I guess, or redact like key personal information. You basically put that out there and see what the insurers are willing or may be willing to do with it.
Just to bring it back to, if anyone's gone through a home loan process or gone through a mortgage broker, it's like submitting a home loan application before even understanding your borrowing power. So there's a lot of work involved in submitting a home loan application. But if you expect to borrow $1 million or whatever, $500,000, but that lender's only going to give you $400,000, but another lender's going to give you $600,000, well, you're wasting your time going and applying and getting through the bank application process if you know you're not going to get the level of cover you want. It's the same theory with us. We want to make sure we're going to get the terms that we want and we expect before we even hit an insurance company out with an application.
Yeah, that makes sense. I'm actually going through the mortgage broking process right now, and they did that already based on the unique requirements. Because that's actually, as an aside, that's actually really important for mortgage broking, because you don't want to just have the spaghetti at the wall mortgage broker who just goes and applies for everything all at once. Because if one denies, it can actually reflect poorly on your application overall. So you're better off having a situation like you're talking about, where you actually just test the water first, understand what's on offer, and then make a more informed choice of where the application goes. So,
and when it comes to insurance, it's infinitely more complex because every individual has their own individual health history. It's not like with lending. It's like if you're an employee, you're on the same income, you should effectively get relatively the same level of debt. But with the insurance, it's so much more complex because it's all based on our individual health history.
Yeah. So this introduces this idea, maybe we can weave these two things together, the idea of disclosing information, which you've already touched on, and you touched on in previous episodes, but the idea of underwriting. So people would be familiar with the term at a high level, but for personal insurance, for life insurance, for income protection, for trauma, however you want to kind of put this through the lens, how can you explain what this process is, this idea of underwriting?
Yeah, so underwriting is basically an insurance company making an assessment on whether they will take you on as a policyholder or not. So within the default level of cover, when you join the super fund, the reason why that level of cover is so low is because they do a blanket underwriting and they say, hey, we'll accept everyone within Australian Super or Rest or whoever the super fund is. And that's why it's very low levels of cover. Now, if you go and increase with your super fund or you go through a financial advisor, you need to go through underwriting, which is just a matter of you've got to disclose everything that is reasonable that may impact your insurance application. So that the new disclosure requirements are a duty to take reasonable care not to mislead or misrepresent the insurance company. So if you've taken a reasonable care not to misrepresent your medical history, then you've met your disclosure requirements. If there's something you should reasonably have known and you haven't told the insurance company, then that's a misrepresentation. And so the insurance company will take your medical history and they'll underwrite it and they'll make an assessment of really one of 4 outcomes from that application. So outcome number 1 is that they will offer you cover on the same premium rate without any exclusions whatsoever. So that's called standard rates. The second outcome is they'll put an exclusion on your policy. So if there is an area of your health that is outside what they deem to be the normal assessment, they will put an exclusion on. Now, one thing to note is exclusions are very harsh, and they're The reason why there are issues because the insurance company gets one chance to assess your health today. And based on the Life Insurance Act in Australia, it's guaranteed renewable. So they can't ever cancel your policy on you unless you stop paying your premium. So they've got to kind of make an assessment. If you're 30, they've got to make an assessment on the next 35 years of will you claim on this income protection based on the information we know today. And so that's why sometimes for things like an ankle, if you're at a desk job and you bust your ankle, you're in a moon boot, and that happened 12 months ago, they're not going to have an issue with that on your policy. But things like mental health, where it can be, it is a big claiming experience for insurance companies. They will want a longer period of no symptoms or treatment for, potentially up to 5 years, depending on the insurance company. So different health things will have different assessments on whether they will put an exclusion on the policy. Now, the third thing they'll look at is what's called a loading. So they'll charge you a higher premium than the average if they can't put a circle around a health thing and say, hey, that health event will be excluded. So things like high BMI or things like high blood pressure. So they're areas where they can't put an exclusion on one area of your health because it's what they call is comorbidity issues. So high BMI has a higher chance of multiple health impacts. And so what they do, instead of putting an exclusion on it, they will put a loading. So they'll charge you a higher premium for the policy. So if your policy is, $1,000 and they put a 50% loading on it, then it'll be $1,500 roughly. And then the fourth outcome that the insurance company or the underwriters can come to is just declining the application outright. So this is one thing in Australia that they can decline the application. In places like New Zealand, they actually can't decline life insurance applications. They can do up to, a gazillion % loading and put 1 million exclusions on. But in Australia, a lot of insurance companies have like a 3 exclusion loading max. A 3 exclusion max on the policy. So they can't just do 10 exclusions on your policy and still offer you the cover. They'll just decline the cover. And so from their assessment, from an underwriting point of view, they've made an assessment on your overall health and it's outside, it's too much risk for them to take on. So they decline your insurance application.
So that's when people maybe have multiple issues and they can not get any types of insurance, right?
Yeah. And the one thing to note is underwriting is at this point in time. So as I said, if you get an exclusion because of mental health, back, and they're long-term chronic issues, but you've gone to the snow and you've just, busted your ankle, that may be excluded today. But if you apply in 12 months' time, then that ankle exclusion won't be included and therefore you won't get declined. So it is important to have a chat to your advisor. I mean, if you go direct to the insurer, try and have a chat to the insurance underwriter and see if they will, at what point in time you can reapply. But if you're working with an advisor, that's one thing that we do is we always try and get a good sense of, how long is this likely to impact a potential application? And then also post-application, if it's on the policy, is it reviewable in a certain period of time?
This is the thing that always frustrates me about those people that say, just get a better super fund if you want lower fees. And I just think to myself, every time I hear this, Phil, I'm like, oh, it's so dumb. Like, what a dumb choice to make with your money, because you've missed probably the most important thing, which is, are you going to be covered for insurance? Like, a lot of people have that default cover, but then they rack up medical history as they live their life. And I just think it's just like, that's something that people just don't pay enough attention to, particularly young people, because you can be young and have health issues, right? So just understanding the insurance situation before you make those types of changes is so important. There was something else which we did touch on briefly in the episode 3, I think it was, where we talked about income protection, which is one of the things that is quite interesting for folks, in that the tax deductibility of what you pay for income protection. And this obviously depends on whether it's in super or whether you pay it out of your own pocket. You pay the monthly or annual bill or whatever. Can you just talk about that a little bit?
Yeah. So if you pay income protection or in your super fund will claim a 15% tax deduction, because that's the tax rate within super is 15%. If you pay outside of super, income protection is tax deductible. So depending on your marginal tax rate, so depending on the tax that you're paying at the top end. So if your marginal tax rate is, on the top end, you'll get, almost 50% off your income protection. And that's just claimed at tax time, just like any other tax deduction that you might be claiming for. So, donations to charity or anything else that people are claiming.
Yep. Okay. So that's really important for people when they think about their cash flows as well, right? Because depending on their situation and depending on how they plan their finances, it may make sense to go one way or the other, or a bit of both, or something like that.
Yeah. So, there's a broader conversation. Do we want to minimize our monthly cash flow by putting the income protection inside of the super fund? That may make sense, but from a tax position, you may effectively be paying more for that income protection because you're only getting 15% within super versus 45% outside of super for a tax deduction. But there are ways of mitigating. If you do have contribution caps available, you can hold it within super, and then at the end of the financial year, make a lump sum payment, do a personal tax deduction for that contribution. But we're getting closer to tax advice, which we don't do.
Yeah, that's fair enough. No, but it's a good point. Like, it's pretty well understood in our community that like a concessional contribution to super is likely tax deductible if a few requirements are met. So there are multiple layers to that, but the reason that that's brought up is that's important because as you go through the insurance process, if you're not seeing a financial advisor like yourself and the team at Skye, you do have to weigh that up, right? You do have to weigh up what aspects of it from a cash flow perspective you want to you find important, but also from a tax deductibility perspective.
And touching on that, the reason why I say going through a financial advisor to get your insurance is so important is not just because we do it, but also like you touched on, moving super funds in the future. So the reason why you should go to an advisor to set up your policy is because we can set up policies that are external from your super fund, but still paid from your super fund. And the real benefit of that is at the moment, if you lock your insurance within your super fund, it's effectively like saying, hey, I want to buy an investment property in Greensboro and Melbourne, which is where I live. And because I've got that investment property there, I'm locked to one insurance company. And if I then decide from a wealth point of view, actually, I need to sell this investment property in Greensboro and move it to somewhere in Brisbane because I want to invest there, I then have to cancel my insurance policy and then set up a new one because Brisbane has a different insurance policy. That's effectively what it's like locking your insurance within your super fund. You have to move your insurance every time you move your super. But when you have it set it up with a financial advisor, it doesn't matter where you have your super, and you can pick the right insurance policy. So in the future, if you decide to move from Australian Super to Rest to Host Plus, and you can move 100 times, you hold that one insurance policy, and all you need to do is sign a new form to get that new super fund to pay that insurance premiums for the next year. And the other reason that it's important, and talking about tax deductibility and income protection, is as advisors, we can set up your policy so it's paid within your super fund for income protection. And then over time, as your income grows and you want the tax deduction outside of super, we can actually do what's called a cancel and replace. So we can cancel that policy, place it outside of super, and effectively you don't go through any underwriting. And so it's much more flexible. So you can start off by factoring in, hey, I want cash flow to be the most important thing that we protect. So let's get income protection paid through super. Over time, you may decide that a tax deduction is more important. And then the advisor can help you do what's called a cancel or replace. And you don't need to go through underwriting, no medical disclosures. So if you do have a health event in between those 2 points in time, then it won't impact your income protection.
That's really great to know, because then one, you're saying that you don't necessarily need to stay stuck with the super fund, but you also don't need to be stuck with the way that you're paying it right now as your life changes, because, hey, it is actually, at the end of the day, the same insurance and the same person that's being insured. So it would make sense, right, from everyone's perspective. Okay, so there's only probably 2 more questions, and one of those is the action point for this episode, Phil, which we might put together in a bit of a checklist for people to access in the show notes. But the question is more so about like just renewing things. Like, so if I go through the application process today, just to confirm, in a year, if I pay annually or whatever the case may be, I don't have to then do another application.
Nah, yeah, life insurance under the Life Insurance Act, which we talked about in episode 1, the different acts, is it's guaranteed renewable. So the insurance company can't cancel your policy unless you stop paying your premiums. So it'll automatically renew. A lot of policies will automatically increase in the level of cover. So income protection, you want to make sure is increasing as your income's growing. And so, it'll just automatically renew whether you're paying via cash flow, whether you're paying via your super fund, it'll just automatically deduct. The only thing sometimes you just need to factor in is if you've set it up through a super fund, through an advisor, is sometimes like there's a lot of consolidation within super. So your super, a client of mine emailed me over the weekend, they were with Verve Super and that's now merged with Future Super. And so given that's the process, the insurance company just needs a new form signed to say, hey, can we take the money from Future Super now because Verve's now closed?
Yep, that makes sense. Okay, so every episode of this series, I ask you for one action point that you can give to our listeners and viewers. It doesn't have to be specific for this episode, but if it is, that's great. In previous episodes, you just said, just be aware of your cover, and you brought up some other things like just question everything that you might be going through. For example, I have that medical questionnaire. In my case, you may have filled out, 5 or 6 years ago. Just ask for a copy of that. But in this episode, what are you going to leave us with, Phil?
Yeah, I mean, for me, medical disclosures is the most important thing when it comes to insurance. That's why as advisors, we ask a million questions up front so we can tailor the recommendation to the right person. But my advice is if you've got a policy in place today, go back and try and obtain that medical disclosure and just read over it and go, was this true at the time? Because it's a fairly small amount of work today, but at claim time, that is what the insurance company is going to base their claims assessment on. Did you lie or tell a mistruth at that point in time? And that's really important to just know while you're not needing the money, to just fully understand, that was true and correct. I can put that away now and I can lean on that at claim time that it was true. Or, hey, actually, that may not have been the case. I may have actually had symptoms of this, even if I didn't get treatment. And the question specifically asking about symptoms and treatment. And so that's really important if you've already got cover in place. If you're about to go through the process and get cover in place, just spend a bit of time thinking about, did I go to the doctor in the last 3 years? What was that for? Because, if you're like me, I totally forget that I went to a specialist like 12 months ago and it was a non-event, but I still went to the specialist. And so making sure when you're going through the process, you're disclosing that.
Yeah, that makes sense. Well, like I said, we're going to combine a heap of these, and I hope folks can tune into this, the next few episodes where we talk about how to review and adjust cover through time. That will be the next episode. And then the final episode is what happens at claim time. So the next 2 episodes will probably be a bit shorter for folks. So if you made it this far, may as well finish off the last 2. Really important to get on top of your insurance, particularly if you've got family, if you've got a mortgage, if you've got a business, just realistically, if you've got responsibilities in your life. So Phil, this has been great from Skye Wealth. Really appreciate your time.
Awesome. Thanks, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.